On to Common Sense with Craig. The temporary deal between Democrats and Republicans to raise the debt ceiling prompted a rally on Wall Street. Craig Bolanos, the CEO and founder of Wealth Management Group, is here. Craig, investors may be wondering how the debt ceiling affects their money, and that is one way.
Well, whenever politicians practice the art of brinksmanship, I'm going to get questions about the debt ceiling, so let's understand what it is. The debt ceiling is basically the limit on how much the federal government can borrow as set in statute. So in order to borrow more, the U.S. Congress needs to convene and make an agreement to keep on borrowing. That's what raising the debt ceiling means.
Explain exactly why raising the debt ceiling is critical.
Well, the U.S. government uses a combination of revenue, aka taxes, to pay most of our bills. Bills being things such as Social Security, Medicare, military salaries. And in addition, you have to not forget that we also have to make payments, that's principal and interest, on the monies we've borrowed, aka the debt from the past. And if we don't raise the debt ceiling, the government literally might not have enough money to pay all of its bills, and that could lead to something scary. That scary thing would be a default.
And in the end, Congress always raises a debt ceiling.
Yes, Congress has raised it whenever it's been needed in the past. In fact, Congress has actually coalesced together some 79 times since 1960 to raise the debt ceiling. But a common misconception is that we raise the debt ceiling for new spending. That's actually not the case. Lifting the debt ceiling allows us to cover current obligations that have already been passed by Congress, as opposed to authorizing new spending.
Craig, tell us more about how all of this affects the stock market.
Well, humor me. Let's jump into our hot tub time machine and go back to August of 2011, which was the last time there was a major debt ceiling showdown. And it grabbed the attention of investors across the globe. And even though Congress acted just before the deadline, just before we weren't able to meet our obligations, the problem was one of the three rating agencies, Standard & Poor's, well, they downgraded U.S. Treasury debt from AAA to AA. And you know what? That sent shockwaves through the financial market. I mean, it even caused the S&P 500 to fall by some 16% in just 21 days, aka the sky was falling. So I think the takeaway is that, given the 2011 experience, it's prudent for Congress to reasonably raise the debt ceiling from time to time when it comes into play. Playing political brinksmanship with the debt ceiling, it's probably a dangerous game with relatively little to gain. And if we're being honest, so much to lose. And for us as investors, we need to pay attention to the headlines to not only protect in the event that things go poorly relative to debt ceiling negotiations, and to ensure that if there is a disruption, that we as investors can seize opportunities by buying stocks when they might go on sale in the future. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you want to learn more, you can. Go out to our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.